Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed end funds and an income focused strategy. It's not polished, it's not scripted, and it's definitely not hard thinking. We don't chase headlines here, we navigate markets. And I'm not a financial advisor, I am a strategist. I go where the data leads, even when that means walking alone. So, welcome back. What changed this week? Well, remember our economic bodies of water as we go forward: currents, waves, ripples, and tides. The headlines changed this week. The currents did not. America remains the strongest economy in the world and continues to attract capital. Waves and ripples will move markets day to day, but the deeper financial currents are still flowing in the same direction. And those deeper currents are what steer everything. Right now, those currents continue to favor bonds and bonds proxies, end to end energy, technology infrastructure, and real estate. And the surface might look chaotic, but the deeper currents are still pulling the market forward, which raises an interesting question. If the currents haven't changed, and they haven't changed for a while, why did one of the strongest bond funds on my watch list suddenly drop in price last week? Hold that thought, or at least give me time to answer that question. So, to understand the surface first, the overall current, think about your portfolio like a giant diesel dump truck. The payload bay is empty. If the truck is sitting on perfectly flat ground in neutral, it won't move. It just sits there. But if you place the same truck in a strong current, something different happens. The current pulls the truck forward. And in our system, the payload bay fills with dividends while the truck is moving or gets pulled. That's the goal. We're not trying to react to every wave or ripple on the surface. We're trying to find the deep financial currents that pull us forward and pay us through the ups and downs of the market. Last week, last week I had to make a decision that took me several days to work through. Two funds landed on top of the list last week: NBXG and PDO. NBXG represented or presented a very clear price dislocation. It slipped well below our average cost to share and offered a strong opportunity. The fund is heavily weighted toward 5G technology and tech infrastructure, and it sells covered calls, which can be extremely useful during volatile markets, and it supports a dividend right around 11%. On the surface, that looks like an easy decision. But another fund also showed up on radar: PDO. If you look at my portfolios, the portfolios are structured differently, and that strategy matters. The Roth IRA is designed to become a bond and bond proxy powerhouse, both US and international. The individual cash brokerage is more flexible and more opportunistic. Both portfolios share some anchors, mostly because the Roth existed before the brokerage account was created. And over time, that overlap will shrink as positions rotate and profits are redeployed into stronger long term anchors. And that's where PDO comes in. There are several bond funds I've tracked for years. I don't chase them, I don't bend my rules for them. I simply wait until the data lines up. PDO has been on that watch list for a long time for that cash brokerage account. So when the fund finally suddenly presented a wider discount and an asymmetric price drop, the question became, was I being selfish by pursuing PDO? Or was I ignoring a better opportunity with NBXG? In the end, the decision came down to two things. First, NBXG is a powerful technology and infrastructure fund, but the sector itself is entering a period of disruption. Artificial intelligence is already reshaping the tech landscape, and I believe we'll see more volatility and more dislocation in that space before things stabilize, which which could be a great opportunity. I agree, but there's more. So, second, it's very difficult to look past bonds right now. PDO just isn't another fund, it's an anchor quality bond fund on sale. And that kind of opportunity doesn't appear very often, like we'll see in this week's final closed end fund snapshot. So, if you look at the news for the week, most of the headlines this week focused on the tensions around Iran and the Strait of Hormuz. To the herd, it looks like the beginning of a major war. To contrarian investors, it looks like surface tension. The Strait of Hormuz carries roughly 20% of the world's traded oil supply. And when headlines suggest it would close or could close, markets reacted immediately. But the deeper current is energy security. Multiple countries, France, the United Kingdom, Japan, South Korea, and others, have already committed naval forces to keep the shipping lane open. That tells us something important. The world's largest economies have no intention of allowing the shipping lane to close. So while the headlines look dramatic, the deeper economic current remains intact. Energy continues to flow. Markets continue to adjust. And investors who can see past the waves often find opportunities the herd is too distracted to notice. Another story gaining attention for the week is the so-called private credit crisis. And that brings us back to the question I mentioned earlier. Why did one of my favorite funds suddenly go on sale? The answer may be simpler than the headline suggests. What's being called a crisis looks far more like a hiccup than a systemic collapse. But hiccups can linger long enough to create ripples. And when those ripples hit private credit, they often spill over into publicly traded income funds, including closed end funds. And that's where opportunities start to appear. Private credit funds often hold loans that are difficult to value. Why? Because those loans aren't actively traded. They, it can create the illusion of stability, even when the underlying risk is increasing. And in contrast, closed end funds holding publicly traded bonds offer far more transparency. Their holdings can be priced daily, and their discounts to net asset value, or NAV, can create significant value opportunities for income investors. That's part of the reason the current environment is so interesting for closed end fund investors. Cons- concern, Concerns around private credit may actually push more investors toward transparent income vehicles like bond focused closed end funds. And the dynamic reinforces the current opportunity in funds like PDO and the hesitancy in funds like FSCO. Funds like BRW and SABA or SABA, managed by billionaire activist and financial guru Boaz Weinstein, exist in the middle. Boaz heard the credit crisis fears and saw an opportunity. Michael Foster, and I quote him. So it quotes, Weinstein is known for targeting closed-end funds, but he's taking a break to go after private credit funds, offering to buy out shareholders at big discounts to the fund's NAVs or net asset values. His moves are justified. Private credit mainstay Blue Owl Capital, for example, recently halted redemptions in a fund that holds billions in private loans, causing the firm's shares to plummet, end quote. For Boaz, that's a great strategy. But with the credit market experiencing more volatility and looking for stability, BRW and SABA might see more downs than ups in the near future. And in the long term, that's okay. But in the short game, those bumps aren't for everyone. So with the financial table set, let's move into the closed-end fund snapshot for the week. Here are the top funds for the opening bell and why they made the list. So bear with me as I share my screen. So here's the list mostly sorted, but I left a few on there before I do the full sort because I wanted to show you some things. So Generally, I target triple asterisks, but occasionally the double asterisk, the dollar cost average moves make the list, or at least the pre-list. IGR is a global real estate fund, and it pays a consistent, amazingly consistent dividend. And it pays the largest dividend of the list. If we bought it, if so, we have bonds and bonds proxies, right? Bonds and bonds proxies, end to end energy, technology, and real estate. But it's really hard to look past bonds. But I could break that rule. And some of you would be in agreement with that. It doesn't meet the triple asterisk rule. So that's the rule I would be breaking. But if we bought IGR and with the money I have, I mean, we would have plenty of shares, which would double the funds I already have. But it buying that many shares would decrease the average cost of share on my end and bring that average cost down to about $5 a share, which is insane in the sense of, for whatever reason, the price dislocation is that wide. I can't explain it. It pays a fat dividend, it pays monthly, it ticks a lot of boxes, but it doesn't meet the discount threshold, or at least it's not a current historical discount. And there are better deals on the list that play into the current market dislocations even better than IGR. So IGR would be a great pickup, and at any point, like as a dollar cost average, it's a great pickup. But if I'm going for the most bang for the buck, if I'm going for the best overall deal, there are better deals. So that leaves a ton of bond funds, mostly U.S. and international bond funds, and I'll get to why this one is listed down here. But we have AWF, DOY, PDO, a ton of like all PIMCO funds, plus a double line in Alliance Bernstein. So when it comes to the top three run bond funds, these are these are those three companies. They have more bond funds than these. Like Double Line has DSL, which we own. PDO, I bought last week in that cash brokerage. I think I bought it last month in the Roth. But then they have all of that other stuff. Uh, AWF, Alliance Bernstein, is like an overseas bond guru fund, and it does not hit this significant of a discount often. And like I said earlier, I track funds week to week. I systematically go through my list, and it's got to meet the metric. I don't bend my rules just to buy funds, because if you bend rules, quite honestly, if you bend the rules, they're not really rules. It's like the pirate code; they're more like guidelines. So I don't bend my rules, even for me. So when something presents itself that's significantly different than normal, that's worth paying attention to. So just based on the triples, the discount is wider than it's been in a considerably long time. The price is wishy-washy. The price comes and goes. We all know this. The dividend is consistent, not IGR consistent. IGR actually raised their dividend during COVID and has kept it raised. AWF looks like they cut it just before COVID, but since that time has been the same dividend, like year in, year out, month in, month out. And occasionally they pay special dividends. DLY occasionally pays special dividends. PDO occasionally pays special dividends. And of the bond funds, these are the three best bond funds outside of Nuveen, which it does have bond funds, but it's also like it's a municipal bond powerhouse of bond funds. So trying to filter this list down to two or three is very challenging. What was on the list last week, quite between NBXG, which already didn't make the cut, and PDO, which isn't the best deal this week. So if if we eliminate everything currently on the board of what you can see. They're all triple asterisks. Besides AWF, they all pay better than a 9% dividend threshold. They all pay monthly. It really comes down to price, but even then, there's a better metric. It's the current dislocation between their current discount and the traditional average discount. So AWF has the longest overall historical discount. Let's see. The others have not been around as long. So I would pay more attention to the the average floating, I guess you could say, but the average 52-week discount and look at the dislocation between those numbers. So let's see. There we go. So we're at about a 4% difference here. Now, besides the couple that are actually discounts, these others that exist in premium are premium. So instead of paying $1 for each fund, it's like paying $1.02 or $1.05 or $1.08 versus this would be paying 90 cents for every dollar invested or 92 cents for every dollar invested. So buying this fund at the top, that's almost like getting a 4% discount. Same as that, almost a 4% discount. Well, you're getting, say, like a 2.1, right? Or maybe even a 4.2% discount, 10% discount. This was greater last week. Currently, it's at 2% off. 8 sits above their average. 10 also sits above average. So if I was buying for the Roth this week, it's a clear automatic thing. Like the PHK has the lowest price, but it's only a 4% discount versus AWF rarely comes on sale this significantly. It's a clear win, but it's also the only fund I could pick up 100 shares of. If I waited a month, like if I waited till the end of the month, then almost everything on the list outside of that fund, I could pick up at least 100 shares of. And I'm not buying tomorrow. So if I bought tomorrow in the Roth, I would buy AWF. Question becomes, what are the best buys in the cash brokerage? Knowing that I just bought PDO last week and I can't buy, so that's not really accurate. That might be like $100 until my dividends roll over again. So that becomes what's the best buy for the individual cash brokerage account, knowing that I'm not going to buy anything tomorrow. So having gone through the list, AWF would be an option. DLY would be an option. PDO we just bought. The greatest dislocations are PTY and AWF. So all of this other stuff vanishes, even though we just bought that. Like if I was buying tomorrow and I had the money to buy these funds, I just bought PDO. It's just interesting week to week how the data changes. But now the best options are these two for this week. Now it comes down to personal preference. PTY has a ton of upside. I will pause for 3 seconds in silence and you can, pause the video and go back and read that all you want. AWF has this to say. So it depends on personal preference and how strict to the guidelines, how strict to the rules you want to be. The goals are triple asterisks, monthly payers, below $16, but I really try to stay under $15 to $14, right? Consistent or the potential to have rising dividends, but also that 9% threshold. But I will make exceptions to the rule. And I want to make sure I say this well. I will make exceptions to the rule. And I get it. We're debating a premium fund and a discounted fund, but the premium fund compared to its normal is selling for about 10% off. So it's kind of, even though the numbers are different, they're similar, at least in a little bit. But it comes down to yield. AWF is a fund that very rarely goes on discount and very rarely hits this type of significant discount. So, of the two, if I could buy both, I would buy both. If I could buy one, it would come down to how much money I had. Like in the Roth, I don't have the funds to buy PTY, so I would buy AWF. It it's still significantly discounted. It's still a monthly payer. It still pays amazing. It's a great US, but more so an international bond fund, like a just a powerhouse overseas bond fund. So I'm still getting an amazing deal. But if I had the money, would I buy PTY? And to be quite honest, I don't know. I would probably think about it more, weigh my options overnight. I would do a ton of digging in comparative data to see if there was any way I could somehow compare the funds more so than this even. But I don't know if I would find that data. I don't know if I could find something that would really tip the balance in one favor or another besides how much money I had to invest. And if I had enough for both, I would buy both. Problem solved. If I only had enough for one, right, then that would mean I would have less than, fine, we'll say I had just enough to buy PTY. Would I pick up AWF? And this is just my gut going, right? Like my I could logically say this, but also if the if we strip it down to how you think the American economy is versus the overall value of the dollar, if you think the dollar is losing value, which I don't, then that would send you overseas. And if you think the American economy is where it is the place to be, and with inflation dropping, the value of the dollar is going up, then that would lead you at home. So on my end of things, I would, as tempting as it is to buy AWF, I would look past it and pick up the fund with the bigger yield. But to be quite honest, I would still love to buy both. So that's that. The snapshot. Two funds like last week, but two different funds than last week. And there's a gosh, we could get into a huge debate about why that happens, but the data changes, right? Stories come and go, the data changes. And that's the whole point of the weekly videos to evaluate the current data and to find the best possible funds for the opening bell. So I'll leave you with this. And it somewhat ties into why the funds change. Sometimes the funds are the same every single week. The data still changes, right? The price changes, the discounts change, and since the price changes, the yield changes. But it would be the same funds on the list. But sometimes not. So the surface keeps moving. The currents will too. Waves will rise, ripples will spread. But remember the question we answered, NBXG or PDO. The choice wasn't random. It wasn't about chasing headlines or reacting to surface noise. It was about positioning our portfolios in the currents that truly pull us forward. And when it comes to this week, when it comes to PTY and AWF, two anchors that would, gosh, two anchors I have watched that would continue to help anchor, God, the pun, or the redundancy. Two funds that would further help me anchor my portfolio. Sometimes sometimes the choice is individual. Like I can do the best for my portfolio, and you should do the best for you and your portfolio. So what I pick for me might not be what you pick for you. And I'm certainly not picking for you. You have got to do the best thing for you. And that is knowing your portfolio and knowing where to go and knowing what you should be targeting. So getting back, so it week to week, it's all about positioning our portfolios in the currents that truly pull us forward. And when we do that, when we trust the flow, follow the deeper financial currents, and anchor in what's proven, we don't have to guess, right? The choice between PTY and AWF really is like flipping a coin. They're great. They're both great funds. They're both excellently managed. They're both amazing at what they do. There's just some slight difference, some slight nuance. But I don't think you should make your portfolio decisions on a coin flip. Okay, so when we anchor our portfolios in what's proven, we don't have to guess. The market does the work for us. The dividends keep filling the truck. The payload bay grows. And that question, the one that had us weighing every data point, resolves itself, not in a moment of speculation, but in the disciplined, forward moving flow of the currents we trust. So hopefully this helps you. Hopefully I've given you more information to chew on, more information to think about as you move forward making your own financial decisions. That's all I have for this week. I will see you next Sunday, and I wish you a great week. Oop, there we go. I wish you a great week. Have a great week, everybody. Bye bye.